Hey guys, today's video is going to be on India's largest pharmaceutical contract manufacturer. Recently, the company came out with the IPO, but after second quarter's result, the stock price nearly halved from a lifetime high of 1176 in August 24 to 539 levels. So, I'm talking about Akums Drugs and Pharmaceuticals Limited. So, in this video, we'll explore the business model of the company. We'll also see how the company has fared financially in the last couple of years, and we'll compare it with its listed peers, and we'll also try to explore the possible reasons for the fall in the stock prices. Right. So let's just start with the history first, as usual. Akums was founded by Jain brothers, Sandeep Jain and Sanjeev Jain. Their father used to work in the wholesale pharmaceutical industry, so they set up the pharmaceutical distribution shop in 1984 in Delhi. They kept on adding the shops and expanded their distribution business until one day a pharmaceutical company told them to establish their own manufacturing plant and agreed to buy the production from them. So, taking a leap, they established a manufacturing facility in Haridwar, Uttarakhand, with an investment of about 1.17 crores. So, that's how Akums was born in 2004. Following that, they kept on adding the capacities and capabilities organically and inorganically. In 2010, they started the branded generic segment. So up until now, they used to manufacture medicines for the clients, but in the 2010, they started branding their own medicines to the physicians. In 2019, Quadria Capital, which is a Singapore-based private equity firm, acquired a 15% stake in the company. In 2021, Akums acquired Parabolic Drugs to expand into the API business. So idea here was to establish presence across the value chain of the Indian pharmaceutical industry. Today, Akums is the largest contract manufacturer in terms of capacities, capabilities, clients, and revenues. The company commands about 30% market share in the domestic CDMO segment. So that was about a brief history of the company. Let's just discuss the business model of the company. Akums broadly operates in three business segments. One is CDMO, which contributes about 78% to its revenue. Second is branded generics, which contributes about 17% to its revenue. And the third one is API, which contributes about 5% to its revenue. So let's discuss the CDMO first. Under CDMO segment, the company manufactures pharmaceutical products for its clients. Right. So we already mentioned that the company is the largest in terms of capacities, clients, and revenues. So let's just start with this metrics only. So in FY24, the company manufactured and sold about 17.7 billion products units and generated a revenue of about 3,266 crores. In the last 2 years, that is FY22 to FY24, the company generated a volume CAGR of 2% and a revenue CAGR of 11% in this segment. Talking about capabilities, the company since inception has manufactured about 4,000 formulations across 60 dosage forms. So let's take a step back and briefly understand what this dosage forms means. So there are broadly four types of dosage forms. One is oral solids, which includes your typical tablets, capsules, gummies, powders, etc. Second is oral liquids, which includes your oral syrups, suspensions, oral sprays, etc. Third one is sterile preparations, which includes your injections, ear drops, eye drops, etc. And the fourth one is topical, which is your gels, lotions, creams, etc. So there are subcategories in this dosage forms as well, like there are uncoated tablets, coated tablets, sustained release tablets, etc. That's a bit technical, but the larger point here to understand is Akums has all sorts of dosage forms capabilities, including complex ones, right? So let's discuss the clientele. So Akums serves about 1,500 plus clients in this segment. Akums serves about 26 out of top 30 largest pharmaceutical companies in India. And marquee clientele includes Sun Pharma, Dr. Reddy's, Cipla, Alembic, etc. Top 10 clients contributes about 39% to the segment revenue, which reflects moderate client concentration in Akums revenue. So the question is, how do they sell this pharmaceuticals to the clients, right? So they enter into the contractual arrangement with the client, which outlines the broad terms like the nature of products, duration of the contract, and clients' right to inspect or audit the manufacturing plants of Akums, etc. These contractual arrangements don't mention the fixed quantity or the price at which the client will buy from Akums, right? So they issue purchase orders to Akums as and when they want to purchase these products from Akums, right? So purchase orders briefly mentions this quantity, quality, and the delivery terms that Akums need to follow, right? So there are two key takeaways from this revenue model. One is Akums has to keep a spare capacity because a purchase order can come at any point of time. And secondly, Akums does not dictate the pricing because there is no pricing mentioned in the contractual arrangement itself, right? So the pricing fluctuates based on the API pricing, raw material pricing that Akums needs to follow. Talking about the branded generic segment, as I mentioned earlier in the video, that the company got into the branded generic segment in 2010 through its subsidiary Akumentis Healthcare Limited. Now, the subsidiary has a portfolio of about 140 brands across various therapies, including cardiology, diabetology, orthopedics, pediatrics, dermatology, etc. One thing to note here is that the chronic therapies where treatments last longer, like cardiology, diabetes, etc., where the treatments last longer than a couple of years or so. So these chronic therapies contribute about 69% to the segment revenue. The company has a field force of 1,500 plus medical representatives through which they market their products to the physicians. But all said and done, the segment has not done well in terms of the revenue. The revenue dropped from 900 crores in FY22 to 700 crores in FY24. The management has highlighted in the con calls that they are reducing the focus on the trade generic segment to improve the growth and margins of the segment. So that's about the branded generic segment. Now let's come to the API segment. The company got into the API segment through the acquisition of parabolic drugs in 2021. They manufacture key starting materials, which is like a raw material for API, intermediates, and the API for their clients. The company has a portfolio of about 20 approved drug master files, DMF in the US, and 15 active APIs that they sell to 200 plus customers. The revenue has almost doubled from 109 crores in FY22 to about 213 crores in FY24. So that's almost double the revenue, right? But key thing to note here is that one API called cephalosporin contributes about 85% to the segment revenue. So there's a significant product concentration risk here. Secondly, this segment is not profitable on the operating level. On EBITDA level, the segment is still incurring losses. So we'll also touch upon that later in the video, but this is something to keep in mind. Now let's come to the manufacturing capabilities. So as we already discussed in the video, that Akums has all sorts of manufacturing and dosage forms capabilities, right? So Akums has 12 manufacturing units for its CDMO and branded generic segment in the states of Uttarakhand and Himachal Pradesh. And for API, the company has 3 manufacturing plants across Punjab and Haryana. In terms of capacities, the company has a capacity of manufacturing about 49.23 billion units. So that's roughly about 5,000 crore units for its CDMO and branded generic segment. And for API, the company has a manufacturing capacity of about 738 metric tons per annum. So that's about the manufacturing facilities. Raw materials are sourced majorly from India, from domestic suppliers, and some of the raw material is sourced from China as well. So that's the story of manufacturing capabilities. All right. So let's analyze the financial performance of the company during last couple of years. So as I mentioned, that Akums works on the cost plus pricing model, right? So Akums doesn't dictate the pricing to the customers. So volume growth is one of the important drivers for the revenue growth as well as profitability. So let's just start with the capacity utilization itself. So capacity utilization dropped from 42% to 32% from FY22 to FY23 before improving to 38% in FY24. So the drop in this capacity utilization was on account of capacity addition done by Akums, and capacity utilization hasn't kept up the pace with the addition, right? So that's why the capacity utilization dropped. One thing that I want to highlight, that in this industry, the standard capacity utilization is about 50 to 60%. So comparatively, Akums has a lower capacity utilization rates in the industry. Talking about the revenue growth. So revenue increased from 3,672 crores in FY22 to about 4,178 crores in FY24. So that's roughly 14% CAGR in 2 years, right? Gross margins of Akums over at about 38 to 39%. As I mentioned, no pricing power, so the gross margins are comparatively lower. Before we get into EBITDA and PAT margins, I need to clarify one thing. So Quadria Capital, as I mentioned, holds about 15% stake in the company, right? So as a part of shareholders agreement, Akums acquired to buy back Quadria's stake as a part of certain exit rights given to them. So this is essentially the put option given to Quadria Capital and a put option liability on account of Akums. So Akums had to account for changes in this put option liability every year in the financial statements. So it's a notional adjustment. It does not include any cash outflows, but the changes in this put option liability basically impacts the P&L. So if you look at the screener, it would appear that the company is loss making, but it's not the case because of this notional adjustment. So after these adjustments, EBITDA margins come to about 11 to 12% on the average basis, and PAT margins come to about 6 to 8%. In FY23, margins dropped significantly because of the lower capacity utilization and flat revenue growth. With that, let's come to the balance sheet ratios. So Akums has a decent leverage on the balance sheet in terms of working capital borrowings. The company raised about 637 crores in IPO. So in September 24, balance sheet, this leverage situation improved. The debt equity ratio came down significantly because of this fundraise. Right. Talking about net fixed asset turns, which indicates asset efficiency, so that also came down from 3.5x to 3x because of the lower capacity utilization that for Akums, right? Akums has incurred about 250 to 300 crores of capex on an average during the last 3 years. Talking about working capital cycle, so typical working capital cycle hovers at about 100 to 110 days for Akums. If we talk about 3 years average, the company has a decent cash conversion. So cash conversion is about CFO to EBITDA ratio. So that's about 60% for Akums. In FY24, however, the company generated a cash flow from operation of about 498 crores as against the EBITDA of 481 crores because the working capital cycle dropped from 110 days level to 87 days. So because of that, the cash flow conversion improved significantly in FY24. But on a average of 3 years basis, it's decent at about 60%. So that concludes the financial performance of the company. And now it's time for the P2P comparison. So look, Akums has broadly two listed peers, Innova Captep and Vidlas Bartek. So we'll compare Akums based on various parameters with these peers, right? So talking about revenue growth, as you can see that Innova Captep has generated a revenue growth almost twice of Vidlas Bartek and Akums, right? In terms of capacity utilization also, Akums is at the lowest and Innova Captep is at the highest capacity utilization levels. So what happens when these capacity utilizations are lower? Because of that, the fixed cost of maintaining this capacity is higher, but the utilization is not there, so corresponding revenue is not coming. So operating leverage works against the company, and that is reflected in the margins as well. Like Akums has the lowest margins among the peers, despite having larger scale than the peers. So that is one of the important things to note here. Even in terms of asset efficiency and cash conversions, the peers are doing better than Akums, right? So this broad P2P comparison tells you that Akums is lagging on the certain operational and financial parameters in comparison to its peer base. All right. So that brings us to the last and the most important part of the video, right? Why Akums' performance suffered in the first half of FY25. So let's get to it. So in the first half of FY25, revenue declined from 2,166 crores to 2,072 crores on a YOY basis. So that's about 4.3% decline. Correspondingly, EBITDA margins also declined 10% on a YOY basis. If we talk about the segments, CDMO declined 6%, branded generic segment declined 9%, and while API revenues grew by 38% on a YOY basis, operating losses widened from 21 crores to 26 crores in the in the first half of FY25. So overall, Akums has posted a weak performance in the first half of FY25, and management has highlighted about three key reasons of this for this weak performance in the first half of 25. right? So let's get to it one by one. First is decline in API prices. So we already discussed that Akums is a cost plus manufacturing player, right? So it doesn't have any pricing power. So any decline or increase in API prices, Akums has to pass on it to its customers, right? So in the declining API prices phase, the realizations get impacted, right? So even if the company has posted volume growth, but due to decline in realizations, the revenue growth appears weak. Innova Captive and Windlass Biotech have also highlighted this issue in this quarter, but it seems that the impact on Akums is greater than its peers for of the declining API prices. Coming to the second reason, volume decline in the second quarter of FY25. So while Akums posted a healthy volume growth of 14% on a YOY basis in the first quarter, the volume declined by 11% in the second quarter, right? So management has attributed it to the muted demand, reduced order frequency, and one-time contract that they executed in the corresponding quarter last year, right? So we discussed about the negative operating leverage, right? So it's a double whammy for Akums when the realizations are also lower and the volume growth also declines. So any decline in the revenue ends up impacting margins even worse. So that's the second point. Third point is loss-making API business. So we already discussed that its API division is loss-making on the operating level, and cephalosporin contributes about 85% to the segment revenue. So management also highlighted that prices of cephalosporin API also declined during this quarter, right? So despite increase in the revenue, despite revenue growth, volume growth, the profitability suffered because the realizations were significantly lower in this quarter. So these are the three broad reasons why Akums posted a weak performance in the first half of FY25. So that brings us to the end of the video. If you like the video, please do like, share it with your friends, and subscribe to this channel. And let us know your views in the comment section below. Thank you.